Co-Chief Investment Officer with Mirae Asset Management, joins us live from Hong Kong. Rahul, good to have you back on ET Now. Thank you for joining us. Rahul, given what is happening to other emerging markets like Ukraine, China, Russia, Argentina and Turkey, India is doing very well.
Yeah, I think clearly our message to our investors has been that unlike 2000, when all emerging markets behave like an homogeneous pack, life is going to be a lot more different this time. It's going to be heterogeneous. Whichever countries, whichever governments does the necessary things to kickstart growth, to do the necessary rebalancing, that economy would emerge stronger. And to your question on Ukraine, I think it's still a regional conflict. If we see Russia go to Crimea or go towards Kyiv, and you see much serious repercussions in terms of economic sanctions, I think then is when you'll see all equity markets kind of get impacted, as crude may go up by about at least $10 to $15 because Russia accounts for 10% of global crude, 20% of global gas supplies.
Rahul, I was just coming to that point. How it would impact India is, A, because of flows and allocations to emerging markets and thereby India, and of course crude prices, which an economy like India is going to be extremely sensitive to. Do you think the worst is now over when it comes to Ukraine, or there is a possibility of still some escalation in terms of geopolitical tension?
I think it's a fairly sensitive place because it's in Russia's backyard, and the last thing they want is, again, democracy to dominate, Western powers to dominate in Kyiv. So I think it's always going to be a slightly sensitive issue, but what we saw from yesterday was Russia kind of backing down and calling their forces back to the barracks. So I think that's some bit of a comforting sign. And I believe US has also moved in very quickly on this, saying that economic sanctions, political sanctions would come against Russia. So I think that eases the pressure for the time.
You're in a perfect place to answer my next question, and my next question is that at a time when most of the emerging markets are experiencing outflows, we've seen outflows for emerging markets as an asset class for 15 weeks in a row. India's got inflows. Is that a trend?
I think what we've got to look at this emerging market outflows is that 3-4 years back, global emerging market funds were in vogue. Everybody was putting money over there, and now people realize that, again, some of the LATAM economies may not do as well as Asian economies, which is why what you're seeing is broad outflows from EM funds. But what we believe is this leads to incoming kind of quarters as people taking a more nuanced approach where you'll see some of the Asia funds getting money, some of the country funds like India, post-elections getting money.
Okay. Rahul, so let's talk about themes and what you've liked in the past. We won't get into stocks. I respect your compliance here. For the longest time, you've been long on private banks. Is that trade still on, or are you now feeling slightly, slightly disinterested in Indian financials?
No, I think this is the time for private banks. Apart from private banks, what we've liked is also pharma and IT services, which we've been fairly vocal about. And I think this is a time where we're taking some money off our mid-cap IT names, some of the mid-cap pharma names, which have done exceptionally well and are pricing in a lot of good news. And we're moving this money to some of the private sector banks, which are trading at 10 times earnings. See, these are good businesses. Each businesses go through cycles, but I think they've weathered the worst of the cycles well. And somewhere valuations of 1.2 to about 2.5 times price to book, 10-time earnings for about a 15-20% growth in 2 years. I think it's a favorable risk reward. So private sector banks is a key overweight for us. We've been gradually adding a position over the last 1 or 2 months in that sector.
What about IT and pharma, which have given solid returns? Is it time to perhaps book partial profits at least, and perhaps deploy that money into somewhere else, the underperforming names?
Yeah, clearly that's what we've been doing, because invariably what happens with market is when they see the earnings, they get too excited and then they give the top dollar multiple. And that is where you get an opportunity to top slice some of these things which are running ahead of fundamentals. And that's what we're doing for IT and pharma. We clearly believe in the long-term story. I mean, we've got a core holdings which are reasonable percentage of the portfolio. But we're booking some profits and moving it to private sector banks, moving it to some of the infra names which are beaten down, some of the port names which look good long-term stories, and probably even looking at telecom, having seen the sector correct so much.
So the tone of your current activity is to reduce exposure to exporters and revisit domestic stock cyclicals?
Yeah, clearly. I think with what's coming from the opinion polls, it seems like that it is highly likely that we'll get a stable government which is pro-business, pro-investment oriented. Our view is, having seen the currency stabilize, and we'll track monthly trade deficit data very closely for that, what happens is by June, July, you will see inflation come down to a much reasonable level. And from June to September, you'll see a lot of economists talking about, and even central bank hinting to rate cuts towards the end of the year. And that's what market starts pricing. See, we're at the trough of the growth. I think acceleration is something which can be debated. But should we see more positive, progressive policies from the new government and a feel-good coming with currency stable, inflation coming down, it's highly likely that we see growth accelerate quickly in the next 12-15 months to about 6%.
Rahul, it's interesting that you mentioned that you're bullish on the telecom space and you've started to nibble in that sector. Is it just a valuation game, or do you really believe that the fundamentals are going to look up for the sector from here?
I think there was clearly a pain which happened in terms of the huge amount of outgo for the auctions. So clearly everybody was surprised on the extent of these auctions. But a lot of that pain is factored in the current valuation. And again, our belief is data opportunity is a huge opportunity. And we see in China the way it's played out. And at the same time, you're seeing a bit of an uptick also coming in their kind of an revenue per minute. You're seeing consolidation happening in the sector where people like Tata Teleservices are rumored to be up for sale. And there are issues with a number of small French players. So clearly, consolidation is inevitable. So there is an opportunity at these prices in the sector.
Rahul, fair point that the sector could see some consolidation, but the sector also could see some fresh entrants like Reliance Jio. And the fact that telecom companies have paid top dollar to acquire airwaves, that in the short term will only increase and intensify the interest burden.
No, what you're saying has a point, but then that's reflected in the current market caps. You've seen these stocks down 20-25% from the highs they had. And what it also sets is it sets a high entry barrier for a new entrant, that he has to invest so much. And somewhere we're missing that when we talk of new competition, Reliance, they've also invested a huge amount for getting these airwaves. So clearly pricing cannot be entirely hugely disruptive for the sector. So that's really the opportunity, that pricing becomes a lot more stable with limited competition. Everybody's put huge amount of money there. You have a huge growth in data and voice remains stable. And stocks are cheap. Stocks remain cheap at 5 to 6 times EV/EBITDA. So clearly, there's an opportunity for these names to go to about at least 7 times EV/EBITDA over the next 12-18 months.
Rahul, I just want to get back to the earlier point that you were making, about booking out partially from names which have run up, IT and pharma, and start deploying that cash elsewhere. Autos too is a space that you like. But again, auto names are running, each auto company, I should say, is running on fundamentals of its own. How do you diversify and how do you pick out the best names there?
No, clearly, again, what we have at autos is each of these companies, which is whether a leader in two-wheelers or leaders in cars, or again, we have a good export story which comes through Tata Motors. So all these names. But like the way you said, it's each to his own merits, each to his own nuances. So one has to wait for a economic uptick where, again, all these companies have cut costs. They have competitive products, and as the demand recovery happens, you can see the very strong flow through coming to the earnings.
What is it that you like? You like players with a global exposure and a good one at that, or are you more bullish on the rural stories?
I think global exposure is preferable, because what you need in an auto company, a successful auto company, is a very strong model lineup, and that's what we see in the company with the global exposure, where every kind of 12 to 18 months they have a winner, and they're fairly small part of this premium luxury market where the demand is huge. And we can see next 3-4 years a meaningfully different size and scale from this company, and valuations also are attractive. Gives you some bit of a risk hedge against rupee depreciation also. So clearly global exposures are a lot more preferred to domestic exposures, which have their own set of issues. I mean, two-wheelers may be competitive, though you have a margin uplift coming for the leader over there. Or again, in cars, you've had this recent issue of a plant in Gujarat. So you need to see more insights, more details on that. So those would weigh on the valuation for those specific names.
Rahul, while investing into cyclical stocks, are you mindful of the election risk, or are you happy to invest into cyclical names, economy-related stocks, irrespective of the election outcome?
No, clearly you're mindful of the election risk, which is why one is not going down the curve, which is why one is not even buying cyclical stocks buying public sector banks or buying infra companies with huge debt on balance sheets or extremely stretched balance sheets or cash flows. So clearly there is a risk on the election outcome. And even after a positive election outcome, it is going to take quite a while for these companies to heal their balance sheets. I mean, we're not going to go to 9% in a hurry. We've got to work hard for that growth. And the best case is that government does what is expected of it, be more pro-business, pro-investment. You get a favorable rate cycle. Still, what we'll see is about a 6.5% growth. So clearly, I mean, those high beta names did well when we were growing at 8 to 9%. But those times are not going to come in a hurry.
Most of the metal stocks are either below their book or are nearing their book value. Names like Hindalco, Tata Steel, JSPL. Do you think a lot of China noise is in the price? Because if a franchise goes below book, it is always considered to be cheap.
Yeah, clearly, we like some of the metal names in India. And what you've got to look at the metal names is, though the China angle or China's rebalancing may have impact on the global commodity prices, but what's happening with these companies is significant amount of their gross block is in work in progress, which is under commercialization projects, which are stuck for the want of raw materials or nearly about to get commercialized in the next 12 to 15 months. So that would give a significant uplift to earnings, and that's what we're trying to play in our portfolio through. Look at these companies which have some raw materials where they have a significant amount of capital work in progress getting commercialized, which means that in 2 years from now, the cash flows can be meaningfully different.
So, hypothetically, 6 months from now, if we are engaging in a similar conversation on the same forum, what kind of market level, what kind of market do you think we could be staring at? Because 6 months from now, markets would have already gotten the election verdict.
I think a lot would depend on the policies when what we see from the new government. See, right now, it is easy to kind of believe that markets can rally another 5-7% in the run up to this excitement over elections. But post elections, you'll have one more rally of another 5-7%, and then market would wait for execution, which is June, July. You'll see what the cabinet looks like, what are the new policies of the government, and are they actually walking the talk. So I think post this rally, with this period of euphoria, then you go back to action. And if you see government delivering on the action, then we'll get the next big up move of market.
So Rahul, from someone who's sitting outside the country, what's the general view? Because most people seem to be talking about as to how a hung assembly, a third front-led government is going to be extremely damaging and fracturing for the economy. Is that the view outside India as well?
No, clearly there are stretched things. We look at corporates, there are stretched balance sheets. We've seen even with some of the private sector banks, the amount of restructuring is record high. So, I mean, the economy's reached the limit of the pain threshold. And if you get a hung parliament or if you get a third front government and if this pain kind of extends for another 3 years, I think the number of non-performing assets can rise significantly. So that can weigh on the market. So that's really the whole issue. So at this point of time, having seen growth come down from 9% in 2009-10 to nearly about 4.5% now, the belief is that we are at the trough, but you need good government to lift the growth momentum.
All right, Rahul, appreciate your time and thank you for joining us, and I certainly hope to see more of you going forward.